7.49%. Gone in a single trading day. Not a bad earnings call, not a missed delivery number. Tesla had just beaten Wall Street's forecast by 74,000 vehicles, its best second quarter in company history, and its stock still had the worst day it had seen in almost a year. One day earlier, on the other side of the Pacific, a different company quietly filed a number of its own. Tesla's press release never mentioned it. Here's the part almost nobody covering this story connected together. The number that actually explains the crash wasn't in Tesla's report at all. It was in someone else's, filed 24 hours earlier, and released a day too soon for Tesla to control the story. You're about to find out what that missing number means for anyone still betting on where this stock, or this company, is headed over the next 5 years. July 2nd, 2026. Tesla walks in with the best delivery numbers it has posted in 4 years. 480,126 vehicles, not just above expectations, 74,000 vehicles above them, an 18% beat most automakers would build an entire earnings call around. 442,936 of those were Model 3s and Model Ys. The rest, Model S, Model X, Cybertruck, added up to just over 12,000, and for the first time in recent memory, Tesla delivered more cars than it built. Roughly 28,000 vehicles came out of inventory instead of piling into it. 1 quarter earlier, the opposite happened, nearly 50,000 unsold cars sitting in lots. On paper, this is the comeback story. 2 straight years of shrinking sales, reversed in a single quarter. Then, within hours, something happened that the spreadsheet did not predict. Tesla stock fell 7.49%. Not a dip. The worst single trading day for TSLA in almost a year. If you're one of the millions of people holding this stock in a 401k, a brokerage app, a kid's college fund, that's not a rounding error. That's real money, gone, on a day the company did everything a company is supposed to do. So here's the part nobody at Tesla is explaining out loud. How do you beat every number that matters and still get punished for it the same afternoon? The easy answer floating around financial media is sell the news. A stock that ran up too far ahead of the report, correcting itself. Tidy, convenient. It's also not the whole story, because the number that actually moved this market that week never made it into Tesla's own press release at all. Here's why the rest of this matters to your wallet, whether you own the stock or just the car. Look past the delivery number, and Tesla's quarter gets stranger. Its energy division, the side of the business that installs megapacks and Powerwalls, deployed 13.5 gigawatt-hours of storage in Q2. That's up more than 50% from the previous quarter and roughly 40% higher than the same period last year. Picture what that number actually is. Enough stored electricity, deployed in 3 months, to matter to entire power grids, not just car buyers. And one buyer of that megapack hardware is not who you'd expect. SpaceX, a separate company, also run by Elon Musk, spent $269 million on Tesla Megapacks back in April, according to its own IPO filing. That deal is feeding the power-hungry AI data centers behind xAI. 2 Musk companies, 1 invoice, no outside customer involved. That is not a detail Tesla's delivery report was built to highlight. Meanwhile, on the car side, Tesla just launched something aimed squarely at the part of its business that's actually struggling: American demand. A 6-seat Model YL, starting at $61,990, landed in the US on the same day as the delivery report. The timing isn't a coincidence. The federal EV tax credit, up to $7,500, expired at the end of September last year, and US sales have been the soft spot ever since. Here's the pivot that matters. None of this, not the energy growth, not the SpaceX deal, not the new SUV, is why the stock dropped. Wall Street's real complaint is about what Tesla is now priced on. Some analysts peg the company's forward valuation near 200 times expected earnings. Others put that multiple well above 400. Either number would be unthinkable attached to Ford or General Motors. Both numbers exist because investors aren't valuing Tesla as a car company anymore. They're valuing it as a bet on self-driving software and robots that haven't shipped at scale yet. One Wall Street voice framed the delivery beat itself in more forgiving terms. That's Gene Munster of Deepwater Asset Management, who described the quarter as, according to his own analysis, the first real sign the industry might be exiting the EV winter that began back in March 2024. Encouraging words, but words about deliveries in a stock that's no longer being valued on deliveries. Here's what actually happened in order, because the order is the whole story. One day before Tesla published its numbers, one single day, a different company on the other side of the Pacific quietly filed its own report. BYD delivered 557,090 fully electric vehicles in the same 3-month window. Not hybrids, not a broader new energy category padded with plug-ins. Pure battery electric cars, the exact category Tesla competes in. That's roughly 77,000 more electric vehicles than Tesla sold in the same quarter. Enough to hand the global battery electric crown back to BYD. A crown Tesla had only just, briefly, taken back 3 months earlier. Those figures aren't coming from some enthusiast forum piecing together guesses. They're compiled by Bloomberg and independently confirmed by both Electrek and Inside EVs. The two outlets that track this exact number, quarter after quarter, without fail. Zoom out further, and the pattern gets heavier. Across all of 2025, BYD outsold Tesla in fully electric vehicles by more than 600,000 units. The first time in over a decade any competitor has beaten Tesla at its own game, in its own category. So here is what beating Wall Street by 74,000 vehicles actually bought Tesla this week. Second place. Announced a day before its own celebration, in a report most American headlines never mentioned in the same breath. This is the stakes, and it isn't abstract. Cox Automotive is projecting Tesla's US sales could fall by roughly 20% this year as the tax credit gap bites. If that holds, Tesla's American home turf, the one place BYD still can't legally sell a car, becomes the market carrying the weakest numbers of all. And that leaves one uncomfortable question sitting on the table headed into Tesla's next earnings call on July 22nd. If Tesla can't win on volume anymore, not against BYD, not without a tax credit, not even with a record quarter, then the entire multi-hundred times earnings valuation has nowhere left to hide. It has to be paid for by full self-driving, by Cybercab, by Optimus. Things Tesla is still targeting, not things Tesla has finished. That's not a prediction. That's the bet the market just quietly confirmed it's making. So here's the full picture, in order. Tesla beat Wall Street by 74,000 vehicles. Its stock had its worst day in nearly a year anyway, and the reason wasn't hidden in some conspiracy. It was published one day earlier, in a report from Shenzhen that most US coverage skipped entirely. BYD didn't just outsell Tesla this quarter. It reminded the market that Tesla's old scoreboard, cars sold quarter over quarter, isn't the scoreboard investors are watching anymore. Not the trade-in tax credit, not a bad delivery quarter. What do you actually think Tesla's stock price is being priced on right now? The cars it's building today, or the robots and software it hasn't shipped yet? Because on July 22nd, Tesla has to answer that question with numbers, not vehicles.